Welcome back, everybody, to the Investors Club YouTube channel. Here we focus on personal finance and growing passive income through dividend growth investing. Okay, so today I want to talk about a few things you don't want to do when you start investing, and talk about why new investors usually tend to lose money. Just a precursor to this, all of these examples I did, well, a couple of them, and I learned the hard way that I thought I could share with you guys to maybe keep somebody else from making the same mistakes I did. So the first and probably biggest mistake I made when I first started investing was that I decided I was going to be really smart and day trade. I thought, why would I want to make small gains across years of buying and holding when I could just day trade and make money that way every single day? And I figured out pretty quick that it doesn't work. I'm probably really lucky I was using Robinhood and I could only make 3 day trades in a 5-day period, or I probably would have lost a lot more money. We can, as you can see from my graph, we can go into the chart here, and I'll just show you right now. Right here, I started day trading. Right here. And I made a nice jump up one time. I made some money. The next day, it all was gone. And I did it again. I traded a little bit and I made some money. And then within a couple days, it was all gone. And then I was trading again, slowly making a little bit back. Even peaked clear up almost to, break even, a little above break even. And then completely back down. And I day traded here, down, down, down. And this at the bottom, at the complete bottom, is where I started dividend investing. But so basically my account fell to shit. I made no money. I lost a lot of money. I thought I lost only $700, but at the bottom here it says $1,300. So I probably did lose about $1,300. There's really no way to double your money quickly without taking a huge risk. So if you want to try and double your money in the stock market in a short period, you might as well just pack it up and head to Vegas, because you'll honestly probably have better luck in Vegas than by day trading. Honestly, I've never heard of any day trader become a multimillionaire. There are not day traders, to my understanding, that have a net worth like someone like Warren Buffett or Charlie Munger. So save your money and don't even try day trading. Oh, I wanted to show an article actually that I just found. It says amateur investor turns $15,000 into $1 million, then lost it all. The latest cautionary tale in the day trading frenzy. It says here, Robinhood user Richard DeBotza said he turned $15,000 into $1 million and then lost everything. He told the New York Times, "They make it so easy for people that don't know anything about stocks. Then you go there and you start to lose money." He said he is planning to appeal his case to financial regulators for arbitration. DeBotza's story is a cautionary tale about the dangers of day trading and how quickly losses can mount. Yeah, I kind of agree with what he's saying. They make it so simple for people that don't know anything about stocks. Robinhood, their interface almost gamifies it, which is good, and it's good in a way and bad in another, because it's good because it brings young people to learn about investing, but usually when you're bringing young people, they're going to go for what looks the most attractive. Day trading looks the most attractive, so that's usually what they're going to do. They're not going to buy and hold and look for dividend stocks or good growth companies. They're going to go for those big hitters like this guy, 15,000 into 1 million, and then he lost everything. If that would have been me, I probably would have cashed out, paid my taxes, and done, but he obviously did not. But it just goes to show how many, and I bet there's more cases like this, maybe not to the extent of 15,000 to 1 million, but I bet there's a lot of people that made some money, thought they knew what they were doing, and then just absolutely tanked and just didn't know what to do with themselves. So my advice, don't have to heed my advice, but my advice would be just stay away from day trading in general. Now, my next thing I'm going to look at is the fact that most new investors don't have the guts to stay in a stock when it's falling. I can totally attest to this. I did the same thing. But when somebody starts to see their portfolio, a stock they're holding drop like 5 to 10% down, they usually will sell, even if that stock has the potential to rebound from those lows. I like to say that scared money doesn't make money, because when you're scared in an investment, it's most likely because you haven't done enough research into that stock. Because if you believed in what you saw in that stock, you would most likely hold through those low dips without the panic selling. And when you panic sell, that's when you lose money. See, most of the time, you really don't lose money. I mean, technically, you don't lose money until you sell. You lose money when you sell. I mean, if you hold on to those stocks and they have the potential to come back, then you're not going to lose that money. I know from experience, I first bought some dividend stocks. I was excited to watch them go up. And when they turned out they didn't go up all the time, and they started to sharply decline due to the volatility of the markets, because that was in April, or might have been in July. Markets obviously very volatile. They would start to decline, and I would sell at a loss because I didn't have the guts to hold until it made a rebound. So most investors will see these huge dips throughout their lifetimes, and it's the ones who have the balls basically to hold on are the ones that usually get rewarded. So as long as you hold on to companies that are well balanced and manage these recessions, I really believe that you can not only save the money without losing it, but make money on the upside. So I found this article, and it just has some key points that I wanted to read off. It says, while it might seem counterintuitive to sit back and relax while stocks post swift and steep losses, for investors with long-term time frames, it typically pays to wait it out. Looking at data going back to 1930, Bank of America found that if an investor missed the S&P 500's 10 best days in each decade, total returns would be just 91%, strikingly below the 14,962% return for investors who held steady throughout the ups and downs. And Goldman Sachs says down here, investors with long-term investment horizons should remain invested in stocks. So, as you can see, if you were day trading, say, hypothetically, through all these years you're day trading, and you miss the 10 best days in each decade, one day each year you miss the best trading days, and you're not just holding, you miss out on 14,851% returns, just because you're trying to time the market. Timing the market, basically 10 times out of 10 does not work. I'm not going to say people haven't made money timing the market, but I'm going to say a lot more people have lost money than made money by trying to time the market in trade. Okay, the last thing I kind of want to look at is the tax rates. The tax rates for, let's see, this article is the one I wanted to look at, actually. So the tax rates for long-term investments, I think long-term investments are basically anything after 90 days is considered a long-term investment. So anything before that is short-term capital gains. So as you can see right here, 22%, this is, we're going off single household, 22% from 39,000 to 476,000. 39,000 to 84,200 is charged 22%. And then I came down and I saw that in is it up here? And then I saw that for long-term capital gains for a single household for $39,000 was only 15%. So that's 7% of your returns right there. Say if you were day trading and made the same amount of money, you have to pay in 7% more taxes, which 7% is a lot. 7% not sound like a lot when you think, well, $100, that's only paying, if I make $100, I only have to pay 7 extra than 15, you would be paying $22 on your long-term capital gains. But say you make $100,000 on a trade and you have to pay $22,000 in. That's almost a quarter of what you made, and you had to take that risk. You have just the same amount of much as risk that you could lose that $100,000 and then you get taxed $22,000 on top of that. So it's just I'm just kind of making this video to say stay away from trying to make money fast, because it doesn't work. Trust me, I've tried. As you saw, I lost around $1,300 almost trying to day trade. It doesn't work. If you want to go gambling, pack it up and go to Vegas, and you can lose just as much money and have a lot more fun there. Okay, so where I'm getting at this is that you need to find a system that works best for you. I'm not saying to use the exact same strategy I'm using with dividend growth investing, but find a good buy and hold strategy, whether that be with growth stocks, dividend stocks, anything along those lines that brings in consistent and safe returns. Even if they are 7% a year, it's better than losing 50% a year. And try to stay away from hitting that big pay window, because it looks so good on paper. It looks so good to see somebody that turned 15,000 to $1 million, and then you keep reading the article and it says he lost it all because he didn't know what he was doing trading. But it happens more times than not. But I'm just saying, skip the big pay window, find something that will bring you safe and slow returns, and I think you'll have a good time investing. A lot less stress too. That's the last thing I'm going to say. Day trading is so much stress. So much stress. But anyways, that's a couple reasons why new investors lose money. And that's it for this video. We'll catch you in the next one.